Imagine a force so powerful it touches the cost of your home, the future of your savings, the very value of the dollars in your pocket. Now, picture a president trying hard to bend that force to fit his political goals. That, right now, is the really high-stakes struggle playing out with the Federal Reserve.
Yeah, the whole debate over the Fed's independence, this body set up way back in 1913 to keep our economy stable, well, it's really heating up. Just a few weeks back, August 2025, President Trump did something pretty much unheard of. He tried to fire Fed Governor Lisa Cook for cause, citing allegations from before she even took office. And that challenge, it's almost certainly going straight to the Supreme Court.
And it's not just that one thing either. Right after that, September 2025, there's this proposed rule change in the Senate. The idea is to fast-track presidential nominees, think Stephen Mirren, onto the Fed board. Maybe even get them in place before the next big policy meetings happen. Markets are already reacting. They're pricing in what they see as a less independent Fed.
How are they pricing that in? What are we seeing? We're seeing inflation expectations tick up. Specifically, the two-year inflation break-even rate showed a noticeable jump right after the news about Governor Cook. Basically, that rate shows what bond investors are betting inflation will average over the next 2 years. So an increase means they're expecting more inflation down the road because of this.
Okay, so this isn't just some abstract economic theory or, DC political games. This really drills down to who's pulling the levers that decide if your money grows or just kind of vanishes, or if that American dream, owning a home, stays possible. So to really get what's going on, let's dive deep. What is the Federal Reserve anyway? Why was it even created? What was the original idea?
Yeah, that's the fundamental question, isn't it? The Fed started in 1913. It came about because the country had been rocked by these really disruptive financial panics. Its main job, then and now, is pretty clear on paper. Keep employment high, keep prices stable, and manage long-term interest rates. The original intent, let's say, was to build this independent body, one that could make tough money decisions away from the day-to-day political winds blowing through Washington. A steady hand, basically.
A good hand. Sounds good in theory, but it seems like not everyone sees it that way. It's interesting how many conservatives in particular seem to view the Fed with, a lot of suspicion.
That's right. For many conservatives, the Fed looks like this unaccountable, unelected body holding enormous economic sway. They worry that kind of power can become dictatorial. You have figures like Ron Paul, who've been really vocal critics for years, even arguing against the Fed existing at all. It's not just about the economic policies themselves. It's a deeper belief, a belief that central planning, even if meant well, messes with the natural signals of a free market. And that, they argue, leads to these boom and bust cycles that end up hurting ordinary people the most.
So wait, the argument is that the Fed, the thing created to solve instability, is actually seen as the problem, and that it restricts the president, who is accountable to voters. That seems counterintuitive. If the president answers to us, why shouldn't they control the Fed? What's the thinking there beyond just unelected power?
It's a fair question, and it gets right to how we think about governing. From that conservative viewpoint, keeping monetary policy separate stops politicians from juicing the economy right before an election. Doing things that feel good in the short term but lead to problems like inflation later on. The fear is that politicians, thinking about the next election, will always push for easy money, regardless of the long-term cost. And that leads to what they call artificial interest rates.
Artificial rates. Okay, that's a loaded term. How does it connect to inequality, in their view?
Well, the argument from many Republicans is that when the Fed keeps rates artificially low, it hurts people who save diligently because their returns are tiny. At the same time, they say it pumps up asset bubbles, stocks, real estate, which mainly helps those who already own those assets, the wealthy. So it widens the gap. They often feel the Fed just thinks it has more control over markets than it really does, and these interventions just skew the playing field.
And the criticism goes beyond just rates, right? There's something about government spending, too.
Oh, absolutely. A lot of conservatives see the Fed as basically enabling reckless government borrowing and spending. It just doesn't mesh with their ideas about small government and free markets. There's often a deep distrust of fiat currency.
Yeah.
Money not backed by gold or silver. Some even want to go back to a gold standard. They argue the Fed silently robs us of wealth by, quote, unchecked money printing, which leads to inflation. Inflation, they often say, is just a hidden tax.
A hidden tax. That's a powerful way to put it. How do they see that working? I mean, are there times when creating money isn't inflationary or maybe even necessary, like in a crisis?
It's definitely a complex area. The conservative argument is that this hidden tax is like a slow leak in your purchasing power. The government pays its bills with dollars that are worth less over time, and the burden falls on citizens. They'd point to periods of high inflation as proof. Now, the counterargument, often heard during crises like 2008 or the pandemic, is that the Fed had to step in aggressively, that creating money, quantitative easing, was vital to stop a complete meltdown or crippling deflation. The tricky part, of course, is knowing when to pull back, and whether the Fed can actually do that without political pressure. Which brings up another key conservative idea: rules versus discretion.
Right, what's that about?
Remembering the really high inflation of the late 1970s, many conservatives prefer clear rules for the Fed to follow, rather than letting them use their own judgment or discretion.
Mm.
They don't like what they see as the Fed's unpredictable sort of ad hoc moves. They'd rather have something more automatic, maybe like tying money supply growth to a fixed rule.
Okay, so given this fundamental distrust from some quarters and these arguments against the Fed acting on its own, it almost seems logical that presidents would try to influence it. This isn't exactly new, is it, this presidential pressure?
No, not at all. History's full of examples.
Mhm.
FDR worked closely with the Treasury during the Depression and World War II. President Truman actually pushed out Fed Chairman McCabe in 1951 over financing war debts, which led to an agreement trying to boost Fed independence. And the most famous example probably is Nixon leaning hard on Chairman Arthur Burns to lower rates before the '72 election. Accounts from back then paint a picture of intense pressure, almost daily demands, and many economists now connect that political meddling to the awful stagflation, high inflation, and high unemployment that followed in the late '70s.
So Nixon and Burns is the classic cautionary tale. Against that backdrop, President Trump's approach, it feels like it takes things up a notch, maybe. How is it different or more intense?
I think the key difference is how public and direct it's been. President Trump didn't just quietly pressure Powell. He very publicly called for lower rates, criticized Chairman Powell repeatedly, even reportedly used insults. He demanded big rate cuts, as much as 2 percentage points. His Commerce Secretary, Howard Lutnick, echoed that kind of talk. It really looks like an attempt to make the Fed work directly for the administration's goals. An arm of the fiscal authority, as some put it, basically monetary policy serving government spending needs.
And then there are the appointments. Presidents always get to shape the Fed over time, right? They pick the board of governors for those long 14-year terms. President Trump already put 3 people on the voting committee, including Powell himself.
That's key, and he gets to pick a new chair in 2026 and another board member in 2027. The general expectation is that this will lead to a more dovish Fed overall, meaning more likely to cut rates to boost growth, maybe even if inflation is a concern, potentially at the expense of higher inflation.
Then we have this fast-tracking idea in the Senate, September 2025, trying to speed up approvals for nominees like Stephen Mirren, maybe even before the Fed's policy committee, the FOMC, meets. That sounds like a way to change policy direction really quickly.
It could certainly accelerate a shift, and it leads to this bigger question: just how much control can a president legally exert? Which brings us back to the Lisa Cook situation. That August 2025 attempt to fire her for cause over alleged actions from before her term. That's really unprecedented. Like you said,
Yeah.
it's almost certainly go to the Supreme Court. The fight will be over what for cause actually means in the Federal Reserve Act and if it applies to things someone did years ago.
And what makes this especially, well, concerning for the Fed's independence is what the Supreme Court has been saying lately in other cases, right? Cases like Free Enterprise Fund, CELA Law, Collins v. Ellen. They seem to be giving the president more power to remove heads of independent agencies. It makes you wonder if Congress can even shield these officials anymore.
Exactly. Those rulings have definitely reinvigorated the president's removal power. If the Supreme Court upholds Cook's removal, it could be a massive blow. It could significantly undermine Fed independence, not just for the Fed, but potentially for all independent agencies. It would set a precedent, making it easier for any future president to get rid of governors they don't agree with. A fundamental shift in power.
Okay, so we've got these big battles over independence, appointments, removal power. Let's bring it back home. What does all this actually mean for, the person listening right now? How does it hit their wallet?
Oh, it hits directly. The Fed's interest rate decisions, they flow right into your mortgage rates, your credit card APRs, student loan interest. Now, lower rates might sound good, and administrations often want them to boost the economy. But as some conservatives argue, they can punish savers whose returns shrink. And they could definitely fuel inflation. And here's a point that's maybe not obvious. If rates are pushed down too low by politics, way below what the market naturally wants, it could actually force rates to spike higher later on to fix the imbalance. a painful correction.
That's interesting. Lower rates now could mean much higher rates later. What about that hidden tax idea, the inflation concern?
Right. Groups like the Heritage Foundation argue strongly that Fed policies, especially keeping rates super low and, well, creating trillions of dollars, have basically let the government finance huge deficits. They call this a hidden tax of inflation. It quietly steals purchasing power from ordinary people and gives it to the government, effectively. It means even if you get a raise, your money buys less. It gets harder to save, harder to get ahead.
And we're seeing that play out dramatically in housing, aren't we? That feels like ground zero for a lot of families' economic stress.
Tragically, yes. This is maybe the most visible, most painful consequence for many. Think about it. The cost to buy a typical home has apparently doubled since just January 2021. Monthly mortgage payments doubled too. This whole monetization of housing, where homes become financial assets first, housing second, often fueled by easy money, creates this stark divide, an artificial divide, some call it, between people who own assets and people who can only rent. It risks creating a permanent American underclass. I mean, today, a typical family income can only afford a typical home in a very small number of major cities. It's grim.
That is incredibly tough. A permanent underclass. That's a chilling thought. It raises questions about the very fabric of opportunity. So, what happens to trust overall if people start to believe the Fed has lost its independence?
Well, if the perception takes hold that the Fed is just doing the government's bidding, just enabling borrowing, its credibility takes a massive hit. Trust in the whole U.S. economy could weaken, both here and abroad. Markets are already jumpy about it. We talked about rising inflation expectations. Another sign is a steepened yield curve. That just means investors are demanding much higher interest rates to lend money for longer periods. Why? Because they're worried about future inflation and political uncertainty. They don't trust the Fed's long-term stability as much. It's a flashing warning light from the bond market. Look at Turkey for an extreme example. When the government forced the central bank to lower rates against economic logic, inflation soared past 50% for years.
Okay, so let's recap. We've seen how the Fed, set up for stability, is now under enormous pressure. We looked at historical examples, but also the very direct, very public pressure and unprecedented legal moves happening right now. We've heard the conservative critiques, worries about unelected power, inflation as that hidden tax, and this potential for creating an American underclass through housing costs. And these ongoing fights over removing governors, over fast-tracking appointments, they could fundamentally change how the Fed operates, with real impacts on your money, your borrowing costs, and the country's economic path.
Which leaves us with a pretty critical question to think about. If the Federal Reserve really does lose its independence, if it just becomes another tool of political power, who is left to protect the value of your dollar? And maybe more importantly, what kind of economy are we actually building for the future?